Hey everyone, thanks for joining. I'm just going to give it one more minute or so for people to join, and then we'll get started. All right, welcome. We're excited to be here with all of you today and talk about rental property investing. And before we dig in, I want to do a quick introduction to our speakers. And I'll start with myself. I'm Ryan Frazier, and I'm the co-founder and CEO of Arrived. And rental properties have been a passion of mine for over a decade, and excited to be chatting with all of you today. And then I'm joined by Cameron Wu. And Cameron is our VP of Investments. He has a long history in both managing, pricing, and acquiring rental properties, and in general, a long family history in real estate as well. And Cameron's going to talk through more about how Arrived works and how to get started for anyone who's interested. And with that, we have an exciting agenda for today. I'm going to kick things off just with a little background on why people look at investing in real estate, some of the different ways to invest in real estate, and then a quick introduction to Arrived. And then Cameron's going to take over and talk a bit more about how it works, some of the benefits of investing in Arrived for folks who are interested, and then how to get started. After that, we'll take some questions at the end and do a live Q&A. So feel free to leave your questions in the chat at any point throughout the conversation. Our hosts may get to them live as we go, but we'll also tee them up for some live Q&A here at the end. So to get started, why do people invest in real estate to begin with? And I think one of the reasons overall that investors have long seen real estate as a great part of their portfolio is just that you can make money in multiple ways. And the two main ways that you make money through real estate are property value growth, as you see here on the left, and rental income on the right. And when we look at the way that properties make returns, really those two buckets and the different ways to make investment returns within rental properties is really what has led to the consistency in returns over time. Oftentimes, property values are growing over time, but also they are driving that consistent rental income, even as properties go through different cycles. And we've seen that on the Arrive platform, average dividend yields or cash flow from rental income have averaged between 3.2 to 7.2% on an annualized basis. And then over time, over the last 20 years, we've seen that property value appreciation and the equity returns tied to that has been about 6% per year. And so on average, over the last 20 years, property investors might have expected somewhere between 9.3 and 13.3% historical returns per year, as you see there below. And that's really one of the other things that drive people to look at real estate as an investment. It really has seen a strong historical rates of return. When you look at rental property investing as an asset class, and specifically rental homes, it's outperformed the S&P 500 over the last 20 years, with the S&P 500 delivering about 9.4% annual rate of return and rental property investing 11.7%. And so really it has been, one of those great fundamental reasons that people have looked at investing in rental properties. The next is really about portfolio diversification. And this really goes back to modern portfolio theory. And really the idea that a well-diversified portfolio can achieve the same rate of return, but for a lower relative rate of risk. And real estate has long had or been seen to have lower correlation to the stock market. And so it's been used as a complement to other investments in the public market to provide that diversification. And then the last is really the access to low-cost leverage. Leverage or debt can help amplify the returns beyond your cash purchasing power today. And it really helps improve those returns either up or down alongside the market's performance. And specifically, real estate has long had really the lowest cost of leverage, because these are real tangible assets that have a lot of liquidity value in the market. And so they've been able to kind of operate with these lower costs of leverage, which can be a great way to magnify those return profiles that we're seeing from real estate. And so with that, what are the different ways to invest in real estate? There's a couple of different types of real estate asset classes and many, many ways to invest in them. On the one hand, on the left side, you have commercial real estate. So investing in things like retail, office buildings, or things that you might come across in your community. There's industrial, like warehouses or factories, residential, like single family buildings or multifamily property, and then vacant land. And there's a lot of different ways to invest in real estate. The two that we really are focused on here is one, buying property directly, where you go through the full process of finding the property or land, acquiring it, going through the transaction process, and really going through everything involved with purchasing. And then on the other hand, you have investing in REITs. And when people think about REITs or real estate investment trusts, they're often thinking about public REITs or public real estate investment trusts. And these offer access to passive investing in real estate really through your brokerage account of choice, but are not necessarily as directly linked to property values. They tend to be a bit more correlated to the stock market and public sentiment, and also to forward changes in interest rates. And then you have a new kind of way and class of companies that are coming up that are really about real estate investment platforms online. And these are companies that are making it easier to invest in buying property or accessing different types of real estate investments directly. And you have companies like Fundrise and Realty Mogul that are working to make it easier to mostly access commercial real estate and real estate debt. And then you have companies like Ground Floor that really allow you to act as the bank and provide these debt securities that allow you to kind of play the other side of the equity equation and really help invest in real estate entrepreneurs and the homes that they're developing. And then you have Arrived, and we are a real estate investment platform that focuses on investing in direct ownership of single family rental homes specifically, and allowing you to access that equity and the two ways to make money from rental homes and rental properties without really a lot of the work of buying property directly. And specifically, single family residential homes has been a big area of interest for me over the last several years, which is ultimately, what led to the idea for Arrived. But beyond that, we really fundamentally believe in single family homes as a really strong asset class. We talked about the historical returns that have been, both really strong, but also consistent. And in general, the market has just not been able to keep up in terms of supply of homes with demand. And that's coming from a lot of different places, really that the manufacturing costs of properties have risen, the cost of labor has risen, the access to land in desirable areas has been more hard to come by. And at the same time, there's a lot of interest in rental homes as well. We see that just fundamentally as a society, people are renting for longer in their lives as they're often more open to moving around. And that's creating a really robust renter community that are interested in these homes as well. And so there are these great shifts and market dynamics that really have helped sustain and create a robust investment product for single family homes. But in the past, it's just been a ton of work to really get started investing in property. On the one hand, you need large down payments to invest in a home, oftentimes 6 figures. And you also need to go through the full process of finding properties, acquiring them, taking out a loan of your name, and then being responsible for the property management. And Arrived is really about removing all of those headaches involved in acquiring homes. And so with Arrived, we are really trying to make it as easy as possible to invest in rental homes and shares of those individual homes, starting with just $100. And on Arrived, you can browse individual homes that we have available for investment, pick and choose which homes you like, buy shares in those homes, really with almost any amount of money. So whether you want to invest $100 or $10,000 or $20,000 per house, you can do that through Arrived. And then you start earning income and any property value appreciation right away. Arrived takes care of everything else under the hood. And so it really is truly a passive way to access and invest in rental homes. It's an exciting innovation that we are really thankful to be a part of and be bringing this to market and really sharing it with everyone here today. And with that, I'm going to bring Cameron up to talk a little bit more about how Arrived works and some of the benefits of investing in Arrived.
All right. Thanks, Ryan. So I'm going to talk about how we source real estate. Then we'll go into exactly what are you getting with Arrived. And then we're going to talk about some of the benefits and finally how you can get started. So at a top level, we pick markets, and there are markets that offer appreciation more so. There are markets that offer more dividend income, and really Arrived looks to establish a national footprint where we are buying in all markets. And with that said, there are markets that no matter how they're performing, the homes in neighborhoods will certainly outperform. And that's what we look for. So in terms of markets, we're looking for population growth. We're looking for a strong economy with job growth. And on the supply side, we're also looking for some supply constraints. So if it's difficult to build in that particular jurisdiction, or if there's any sort of regulatory or zoning laws that make it difficult to add supply, that is usually a strong tailwind for real estate values. Next, we look to buy the right homes. I love being close to infrastructure. People love convenience, and that's what they demand in their lives. So we're looking for access points that are close to major transportation, to interstate freeways, to shopping centers, so you can go to the grocery store easily. And that's usually a great sign that an area will continue to appreciate in value, that particular neighborhood. And then we also buy the right homes that are conducive to providing strong rental returns. Not every home is equal in terms of its ability to generate rent relative to the purchase price. So you want assets that produce the most rental income and minimize expenses relative to how much it costs to acquire and maintain that asset. And next, we improve the homes. Our buy box for homes is generally a newer asset. Right now, the average year built for our portfolio is 2017, with about 4 bedrooms, 2.5 baths, around 2,200 square feet. So they're really your bread and butter, kind of suburban, middle to upper middle class neighborhoods that really are great assets. And we improve them even more. So we'll make certain asset management decisions that add what's called revenue enhancing capital expenditures. So a good example of that, or two good examples of that, first is a flooring material called LVP. So anytime we have to replace carpet, we would opt to replace it with LVP, luxury vinyl plank. It's similar in cost, but it's got a 15-year life compared to carpet, which is often 3 to 5 or 5 to 7 if you're lucky and have had really great tenants. And it makes the home look really nice. It adds hard surfaces. And most importantly, it mitigates expenses over the duration of the investment period. Because if it gets dirty, you just clean it. You don't have to go through more expensive deep cleaning, steam cleaning, carpet treatments, or best of all, you wouldn't have to replace it in most normal circumstances. Another example of this is adding a fence. A surprising amount of new homes don't come with fences. But for our asset class, which is often composed of households that either have children or pets, and especially during the post-pandemic era, because a lot of people are able to work from home, pet ownership was definitely on the rise. So having a fence is often a very good value add for the home. So we'll make those types of decisions. Next in our strategy is renting with long-term leases. The industry standard is about 12 months for a long-term lease, and that results in about 2.8 years of average tenancy. The issue that I have with that is when you're on 12-month leases, you're constantly giving options to tenants to, remind them to go out and shop. When we structure our leases, we opt for 18 to 24-month leases, depending on the season, but call it a 2-year lease as our average default lease term. This serves a couple of purposes. First, we're biasing towards tenants that are committed to those neighborhoods and to that home. If you sign a 2-year lease, you're not looking to just get into a home and then look for a new home to buy, and then 12 months later, you vacate the home. A vacancy period within the rental industry seriously harms cash flows because, one, you're not earning rent, and two, which is kind of an unseen risk, when your home is vacant, there's a lot more potential for extreme damage to happen. It can be vandalized. There could be utility problems, pipes could burst, etc. So by structuring these longer term leases and opting towards tenants that are in it for the long run, we believe that this is the superior cash flow strategy. It remains to be seen how long of an average tenancy we get, but if the industry average is 2.8 years, we're hoping significantly longer stays than that. Finally, we offer that to investors. So as Ryan went through the process, there's a lot of steps from acquiring the home, identifying it, underwriting it, getting the financing, going through the transaction. I mean, the number of steps involved and the surface area for the risk involved is really high. So we do all of that. And then on top of that, we also qualify these assets with the SEC. So what you're buying with Arrived is a share of a company that owns the real estate. And that's how we're able to fractionalize that. So with that said, I'm going to go into some of the benefits of investing on the Arrived platform. Passive income. So we do all the work for you, from acquiring through lease up through ongoing cash flow management throughout the life of the investment horizon. We are managing this for you. And as the owner of the company that holds the real estate, you get the full economic benefits, which include both the rental income as well as the appreciation whenever we sell the property. So it's a truly passive experience. And, we believe we've structured a really great product to really replicate exactly what single family residential rental ownership is like, but without having to do all the work. Second, capital appreciation. You receive your shares of appreciation when homes you invest in are sold. This is really one of the great economic reasons for investing in single family residential. And it's a highly liquid asset class. And what we mean by liquid is that it very easily goes between having value in the form of the asset and then having its cash value. Now, there are some transaction costs, but generally residential real estate, and especially single family residential, has appreciated very steadily over time. So our investment horizon is a 5 to 7 year anticipated hold. And by the end of that, net of transaction costs, hopefully there'll be a really meaningful gain through the capital appreciation. Next is no liability debt. You can access low cost debt with no liability for the investors. So we've really structured a great financing program for each one of these homes to achieve positive leverage and also to get more capital appreciation for you, a better return on your equity by the time we sell. So it's no liability debt in the sense that the only item securing the promise to repay the mortgage is the home itself. So you as an investor, you're not liable for the repayment of the mortgage in any way. So even under the worst circumstances, the bank could take back the property, but you're not liable in any sense. This is a far departure from the Great Recession, where we saw a lot of people had foreclosed homes, and then it impacted their credit report, and then they couldn't get credit for 7+ years. So there's no risk of that with the financing program that Arrived has structured. Additionally, you don't need to pass any sort of underwriting requirements when you're investing in these assets. You're buying the equity in the company, and you're not having to qualify for the debt. So whether you have great credit, low credit, or no credit, it's not a factor when investing with Arrived. Next, no operational responsibility. This really ties in with the idea of passive income, that you can get all of the financial pass through without having to do all of the labor associated with identification of properties and then property management. You can start earning rental income through each property and receive quarterly dividends. There was a great phrase that I heard where investors are often looking to avoid the 3 T's: the toilets, the trash, and the taxes, which brings us to our next point: tax advantages. So you can take advantage of tax breaks and favorable deductions associated with real estate investing. So on the part about favorable deductions, that typically refers to this idea of depreciation, which is a non-cash expense that you get to net out of rent. So you pay lower taxes, but it's not an actual expense coming out. It's not cash flow leaving your bank account. It is a financial accounting for the wear and tear of an asset over time. So you get cash flow today without having the full obligation of the tax for those cash flows. You get to defer it to a later period. And then the second tax advantage that is traditionally associated with real estate is the favorable treatment of long-term capital gains rates. So when you sell the property some years down the road, that gain qualifies for long-term capital gains treatment, which is a favorable tax bracket compared to income taxes and the rate paid on wages and salary, et cetera. Next, low minimum investment. You can start investing in real estate without large down payments with our low $100 minimum per property, which is unheard of. You think about the traditional way to invest in real estate. Even if you were buying a $200,000 property, rule of thumb is between putting the down payment down, getting financing, supporting the rehab, you'll need about 25% of that in upfront cash to be able to get the investment off the ground. So $50,000. And if you had $50,000 on Arrived, you could spread it out over a very large number of properties and have a meaningful investment in all of them, which brings us to our next point: diversification. Arrived is the easiest way to diversify your cash across many properties, and you can invest in different parts of the country. You can invest in different types of assets. So whether it has a stronger appreciation focus, but maybe a little bit more expensive today, or if it has a very strong income focus. So you can build your portfolio however you need to support your financial goals. And that really ties into flexibility as well. So not only can you diversify across a lot of different asset classes to be able to meet those goals, but real estate is very much a local game. And it just is, because you're dealing with land and a house in a particular location. So we've been sometimes asked by investors who are in the business of real estate saying, why should I invest with Arrived? I can operate real estate. I know how to identify it and know all the steps. I've been doing it for a long time. And that's absolutely wonderful. We don't think Arrived is inconsistent with the idea of investing in your own real estate. In fact, it's very complementary. The issue with that, though, is it's very difficult to manage real estate investments outside of your own backyard, within a 1 or 2 hour radius of where you reside, because it is so operationally intensive, and it is such a local game. So with Arrived, you can invest all over in different parts of the country with a very similar quality control, and a very consistent process that the Arrived team offers. So how do you get started? It's really easy. You basically log onto the website. There are properties there that you can view the pictures, view the thesis, look at some different stats. And from there, you select the shares amount that you want, and then you click buy now. And then there is a very simple e-sign process where we give you all the kind of legal jargon to say, like, here's how the investment works. And we've timed the process from arriving on the homepage to buying your first 10th or 100th property investment. And it takes about 4 minutes, that simple. And when you're logging on for the very first time and signing up, there's a couple pieces of information that we require upfront that most all investment companies, some is the know your customer rules, KYC as it's commonly referred to. So you'll need to provide a taxpayer identification number, which is most commonly a social security number for individual investors, provide an email, and from there, you're ready to start purchasing. And when you are ready to make your first purchase, we connect your bank accounts through a trusted third-party service called Plaid, which is what most all financial institutions and other service providers use to connect your bank accounts to the intended platform that you want to use it in. And from that point, fund your investment and you start collecting rental income in the most flexible, passive real estate experience that there is. So thanks so much for joining us today. That's the end of our prepared remarks, and we are ready to take all of your questions and hopefully have some great answers for you. Thank you.
Wonderful. Cameron and Ryan, thank you so much for your prepared remarks. I know Cameron had to run and he's coming right back on. That said, Ryan also had to hop to a meeting. So I'll intro myself and Jake will be joining us today. So Jake will introduce himself and then we'll walk through the myriad of questions, keep them flowing in here. To get started, my name's Corinne Headland. Pronouns are she and her. I'm the Senior Customer Marketing Manager at Arrived, so all things customer facing. And then I'll kick it over to Jake and we can get started on questions.
Hi guys, I'm Jake. I run the finances and marketing at Arrived and excited to chat with you guys today.
Wonderful. Perfect. Well, to kick things off on the competitive side, Carmel had a question. Carmel, I'm so glad you were able to join. I think we chatted 15 minutes before this. Carmel has a question, Jake. How do we differ from those other platforms, other real estate investment platforms that Ryan briefly walked through in the prepared remarks?
Yeah, so most other real estate platforms are structured as funds. So when you make an investment, you're investing across a pool of properties that could be hundreds or thousands of properties across the US. And that's good because you're instantly diversified from the first dollar you put in, but there's two major downsides. One is that it's really hard to do any kind of due diligence on a fund that's that big. It's one thing to look at a property or two and analyze the location, kind of the metrics about the property and see if it'd be a good investment. But when there's 1,000 properties all bundled together, it's really, really hard to take a look at the underlying assets and figure out if you're investing in something that's quality or not. The other knock is that, those funds are all very take it or leave it. They have kind of the fund is structured and set up and you can either invest or you cannot invest. And there isn't a lot of optionality otherwise. The way we're building Arrived Homes, you actually pick the properties you invest in. And so you're able to build a customized portfolio that's individualized to what you as an investor are looking for. That way you may be able to say, hey, I really believe in the West Coast and I want to invest in West Coast real estate, or I only want to invest in schools that have a good school rating. The other funds, it's kind of take it or leave it. You're in or you're out. And with Arrive, there's a lot more flexibility to build a portfolio that, is full of things that you want to invest in.
Yeah, it's a good point, Jake. I think obviously there's great platforms out there. What I get so excited about with Arrived is it's a physical property that you're investing in. And we actually do share the address for each property. You can find it on each property page under the series overview. So if anybody would like to go look at it, you're more than welcome to. We're also potentially moving that into a more visible place in the future. So just wanted to let you know that it's accessible today. Jennifer was taking a look at our platform, it sounds like before the webinar, and noticed that we do not have any homes for to invest in right now. Cameron, can you walk through kind of like our sellout time and what that looks like on average, and then perhaps when we'll be dropping new homes?
Yeah, so we introduce properties onto the platform about every 2 weeks. And right now our volume has been anywhere from 5 to 10 properties per property drop. And as far as sellout rate goes, we sell about a property a day. So you would expect that there would be properties available for about a week, but of course, not everything sells out kind of simultaneously. Maybe the prettier ones or the more attractive ones might sell out in half a day. Yeah. We do send out notifications to all of our subscribers about when the properties are going to become available. So you do get some lead time as opposed to checking the website every minute of every day just to check when there's properties. We have our next drop in early April, and we're going to be introducing some new markets, and we're constantly adding new markets as well. And adding more properties to our existing markets. So over time, we expect that the amount of properties per drop every 2 weeks will be substantially more.
Yeah, that's great to walk through that, Cameron. I think too, we've seen them sell out, like you said, in quick as 2 to 5 days. I think this is also a great segue into how hot the market is. I know this is a huge point of interest that people typically ask about. Can you walk through kind of like our process when we're picking out those homes and how we compete, and also how we can still be picky in that process to pick homes that will essentially acquire those tenants that we can keep for a longer time?
Yep. So as far as pickiness goes, it's really tough to acquire assets right now because the market has been so hot. But as an investments company, we are making sure that we're getting good deals on properties and not overpaying on any single property, because eventually they get sold to you, and it's not good for us if you're overpaying for properties today. So on our hit rate, we probably get 5 to 10% of our offers accepted. And as far as our methodology goes, we have internal tools that allow us to bid on properties about the same day that they come in. So we have a couple of advantages when it comes to owner occupants. And they usually have the advantage of price, in the sense that they're going to offer the highest price. And we don't usually win on price. We win on flexibility of terms. So a lot of sellers, they're looking to bridge the gap between when they can sell their home to take out the cash to buy their next home. And Arrived has flexible criteria because we are an investment company and we offer it as a rental. So we're able to bridge some of that gap. We're able to close quickly, and we offer quickly as well. So when we have an enticing offer that says we'll close in 21 days with a cash offer, and you can rent it back for 6 weeks before you can go find your next property, a lot of owner occupants don't, or retail buyers who are looking to be the occupant of that property, they can't have that same level of flexibility because they need a property with more urgency than that. So we're winning on things like that, as opposed to price, because as you all have probably read some of the headlines, owner occupants are very willing to pay a lot for properties and are driving the market up more so than investors. Because when you think about an investor, they have to make a certain return on a property. So that puts a natural ceiling on the price that they're willing to pay. Whereas an owner occupant, as long as the property meets their criteria and fits within their budget, they'll pay whatever it takes to get it. They're not as value oriented as much as they are budget constrained. So they'll pay for those properties that they really desire. And those are ones that clearly we can't win responsibly. So that's kind of a state of the market. And the second part of your question, Corinne, had to do with maybe optimizing for the rental economics, we'll say. So how do we deal with vacancy, and how do we structure our leases and tenancies to provide the best cash flow over the investment horizon? I think the fundamental difference between us and a lot of other rental companies is that we go for 2-year leases, and will really be picky about who we select to get into our homes, because we're trying to provide minimum vacancy over the long run. So the kind of the average in the industry is to structure a 12-month lease. And so every 12 months, the landlord will raise your rent and see if you want to renew. And for us, I come from a really long pricing background in SFR rentals, and I don't find that to be the optimum solution. What people end up doing is they sign a 12-month lease. They'll maybe lease for 4 months while they look for their own home to buy, and then they move out, and then you have to release the property again, which involves paying another leasing fee, incurring another vacancy cycle, and then having to turn the property where you're making improvements and cleaning up the property in general just to get it ready for the next person. So we go for 2-year leases as a minimum when we're renting out to tenants, because we want people committed to that neighborhood and to that asset. And then that 2-year period also allows them to nest in a sense.
Right.
Yep. So they will stay in a property longer if the initial lease term is longer. And then you're weeding out the people that are one and done type tenants. So over the investment horizon of 5 to 7 years, we're betting that this is going to be the cash optimizing strategy there. And sometimes that means that there is a little bit more vacancy up front, because you do have to find the right tenant who is willing to sign that 2-year lease. During the spring and summertime, we don't find that that's a real material limitation. in times when people are moving in the winter months where they're kind of new to an area, we can find that that vacancy can be a little bit longer. So it is a highly seasonal business, but we are getting into a good leasing season. So it is a good time to start investing in properties to capitalize on immediate cash flow.
Yeah, exactly. Cameron, I think you walked through a lot of great points. I know you did. The theme I hear from both acquiring a new property and from acquiring tenants is that we have the opportunity to be picky. I think it was, keep me honest here, the other day, there was a home that was going through inspection that ended up having termite damage. And we walked away from that and decided to not move forward with purchasing that home because the funds that were upfront costs right away weren't serving, obviously wouldn't serve our investors or our business model in any way. So I think it's a huge testament to how the team functions in being picky on both sides to support both the investor and the rental in the best way possible. Awesome. Moving forward through questions here. Venkat's had a question. Can I suggest or refer properties for Arrived? Maybe perhaps in a place I live. This is the exciting part. One of our pieces is wanting to have homes all over the place so you can grow your geographical portfolio. So Cameron, can you walk through our acquisition process? And then I'll also ping it to the chat. Feel free to let us know where you want to see properties as well.
Yeah, as far as being able to recommend properties, definitely. I think that people who live in an area, they're going to have the best knowledge by far about what the best neighborhoods are and other exciting qualitative factors about those areas, such as new employers coming in. So there is a spot on our website where you can make recommendations. It's probably not super clear, and we're revamping this part of the website, but it says, sell us your property. So even if you don't have a property to sell, if you have an area where you're recommending is a good purchase, or you've had your eye on that part of your neighborhood, please send it our way. Like I said, we are revamping it to make it clearer and more easy for you to submit these kinds of properties. Or if you know people that are flippers or turnkey operators who have assets to sell, we would also love to be able to work with those people within your network. So yeah, definitely welcome all recommendations on that front.
Yeah, the doors are open. Pun intended. I did skip over a question here and I did see it pop up in it was asked kind of in a few different ways. So I'm going to consolidate a couple of those questions I saw come through the chat. Jake, can you walk through essentially our ownership setup? And then what happens if the home is just destroyed? So kind of worst case scenario, or like our company goes under. And third part, I'm throwing 3 at you here. Would I lose my investment with that?
Okay. Yeah, let's start from the top. So
Yep.
When you buy shares in an Arrived property, what you're really buying is an ownership interest in an LLC that owns title to that property. So in terms of the ownership structure, what you really own, you own a company and the company owns the real estate. And then Arrive basically acts as the manager for that LLC and does all of the kind of operations related to the property for you. What's really nice about that structure is that the investors are all silent partners. So there's no liability for any of the investors. So if someone trips and gets hurt on the property and sues, if they're suing the LLC and they're not suing the individual investor, and there's no way to break through to the individual investor. Contrasted with, if you were to own your own rental property and the same thing were to happen, they may be able to kind of pierce the corporate veil of an LLC and be able to go after your own personal assets. So it's a huge advantage that you're able to kind of protect some of the downside for both, someone getting hurt on the property and suing, and for the bank foreclosing. They can only go after the house and the LLC itself. They can't go after the investors, personal assets. So let's see. The second part is what happens if we go out of business.
Correct.
So the great news is that, because of that ownership structure, a lot of the value, or really all of the value, is in the LLC and in the inherent property. It's not in Arrive, the company itself. So, kind of rephrasing what I just said is that you own the LLC that owns the property, and then Arrive is just managing the property for you. So if Arrive goes out of business, you still own this LLC, which still owns this property. And assuming that we go out of business because we make some dumb business move and, we are gone, but the property is still standing. The property is still there. The property still has value. It still has, rental cash flow. It still has a roof providing over somebody's head. And so basically the bankruptcy courts would just assign a new manager to manage that investment for investors. And most likely they would just say, let's sell the property and wind this whole thing down. But it's really nice that if Arrive were to go out of business, the properties themselves still have inherent value. So you're not betting on Arrive, you're really betting on the property itself. And the third part is, should you lose money? So this is an investment. Investments can lose value. And on the legal side, definitely there is potential for loss. The good news is that single family rentals have been one of the most resilient asset classes, particularly in real estate over the last 100 years. And we use all the kind of typical protections you would think of for our homes. So we have comprehensive insurance policies. So if there's a fire and the property burns down, the insurance has it covered. If something crazy were to happen, a meteor strikes the house and wipes it off the face of the planet, then yes, there is potential for loss. But overall, with the general trends in the housing market, in terms of low supply, high demand, people moving into secondary cities, we see a lot of potential for the properties, and certainly are anticipating that they'll increase in value.
I think something to add on to that, as far as can you lose money, we have an investment horizon of 5 to 7 years, but that's not any rigid requirement.
Right.
So the last thing that I would do is to sell a property for an investor loss, because these are income generating properties. So if we find that around the 6 or 7 year mark, it's still a down market and we're in a recession, for example, and real estate prices are not that high, then we just would hold on to it and keep generating cash flow. So while it is possible to lose portion of the equity, over a 15-year, 20-year period, it's certainly a possibility. It's not a likelihood. And it really is determinant upon your time horizon. So Arrive is working on ways to provide liquidity, which means just turning your asset into a cash value, so your shares, without necessarily selling the property. So to the extent that you may have to exit before the thesis has really played out, there is potential for loss there. But I would say that the probability of us selling for a holistic investor loss would be pretty low. There might be more operational reasons why some of the equity gets drained. For example, poor operations or something to that effect. But in terms of, are you secure in an equity interest in a single family home? As Jake said, it's a great performing asset class and it's highly liquid, which means it can easily be exchanged for cash value in a market. There are plenty of buyers, there are plenty of sellers. It's a very robust market. The kind of polar opposite would be a manufacturing plant that is making something very specific, where if that went out of business, your salvage value for your assets is extremely low. Right. Selling specialized equipment or specialized real estate, that doesn't have much, that's not very liquid, because there's only so many buyers in that market who would even be interested in something like that. But a single family residential house, there's always somebody who wants to purchase it. So from a risk reward point of view, it's about as good as it gets in terms of investing in a hard asset, provides cash flow, and is a very in-demand asset. So it really depends more on your own time horizon with respect to what your needs are at whatever point in time you would need to sell out of your asset. But we wouldn't proactively sell for a loss on the Arrive side.
And I saw a couple of questions in the chat about our financing and about loans on the properties. And I just add to Cameron's point of, if the market is down, we can just continue to operate these as cash flowing rental properties. We get a lot of flexibility there because of our financing program. So we add, interest only debt to the properties, and we only use about, 60 to 70% leverage. So that means that the monthly interest costs are really quite low. So if the market were to tank and something like a 2008 happens, the monthly obligations and commitments for each property are so low, and we've got such great debt service coverage ratios that we'd be able to kind of withstand that and continue to hold them as rentals until the market rebounds.
Yeah, thank you both for walking through that. I think we have another T, Cameron, to add to what you shared in the prepared remarks. It was trash, taxes, toilets, and now we have tornadoes. So liability piece, it's a great question. I think that's another bonus to the positive of investing in Arrive and not having to worry about those pieces. Paul, I know you had asked when a home would be sold. Hopefully that answered kind of that realm of that 5 to 7 year hold period, but we're not required to stay in that. If you need further clarification, definitely keep us honest here in the chat. We're happy to walk through it. Jake, I'm going to kick the next question to you. Now that we have historical data, can you walk through our historical returns that we have? And then just because obviously he mentioned they mentioned as well that we can't share any projected returns, but we can walk through our historics.
Yeah, so there's two main components of returns when it comes to single family rental homes. The first is the rental income. So that's the cash flow that's generated by taking the tenant's rent and subtracting out all the expenses. We pay out the rental income every 3 months to the investors. And so far our properties have been paying between a 4 to 7% annualized dividend. So that's split up into 4 payments across the course of a year, but that's about what we've seen so far. Now you also earn from the appreciation component, right? As the value of the home rises, the value of your investment into that LLC also rises. And we're actually just getting ready to display share prices in investors' portfolios next month, which will be kind of a cool way for you to be able to track what that unrealized gain is so far. And for the properties that we launched about a year ago, I mean, the housing market has been hot, and those properties are all up, 10 to 15% so far on the appreciation side. Of course, past performance is not indicative of future results. It's been a crazy time in the housing market, and things can certainly go up and down in the short term. We definitely aim for that 5 to 7 year target period where kind of the longer term appreciation trends kind of hold. But so far, the appreciation is looking really good across all the properties. And because of the leverage that we use on those properties, that magnifies the appreciation component. Cam can probably explain that. You've got a good example walkthrough on that side if we want to go that direction. But overall, we're kind of looking at that 4 to 7% dividend range, and the magnified appreciation.
Would you like me to go through one? I can go through a real
Yes.
simple example of levered appreciation. So the principle behind this is that when you take out debt on a property, that stays fixed, right? So it doesn't increase as the property increases in value, it just stays fixed. So like if you buy a property for $100,000 and you use $80,000 in a mortgage and you put down $20,000, when that property goes up 20% to $120,000, then the difference between that and your debt is $40,000. But remember, you only put in 20, so that's actually 100% return on your money, as opposed to only a 20% return on the property. So that's what the leveraged appreciation is, which is what most people who've owned single family rentals or even single family residential, doesn't even have to be a rental, but when you take out a mortgage, the values tend to be steadily increasing such that when you do use that leverage, the return on your money is magnified by the amount of leverage that you've taken out. So the more leverage that you take out, the higher the magnification, but also potentially the higher the risk, in the sense that if the property does go below the value at which you purchased at, then your equity shrinks even faster as well. So we aim for a pretty well-balanced amount of leverage that optimizes for both the coverage ratio on our debt service payments, which means the amount of rental income that we're generating very well covers the amount of interest that we have due on the mortgage. But at the same time, it's high enough such that whenever we do sell for a gain, then that is a very meaningful amount of appreciation or a good return on the equity and capital that you invested.
Yeah, Cameron, I still need to get you a whiteboard when you walk through those numbers. So maybe on our next webinar, we'll have that, but so appreciate you diving further into that. I was taking a look at the chat. Jennifer and Monica, I lumped your question earlier into Venkat's as well. If you need any further clarifications, keep me honest, like I mentioned in the chat. Jake, can you walk through, and apologies, I have 3 dogs behind me, so if you hear noises, that's what's going on. But I'll move forward here. Shantae, Joe had questions around, is there a credit check? What form would I receive for taxes? And then I know we talked about this, Cameron, you mentioned this, but I'm going to kick it to Jake, why we connect bank accounts. So threefold there, Jake, on credit check, taxes, and connecting bank account.
Yeah, so there's no credit check because we're not providing credit to investors. The investment is an equity investment. We're not giving out a loan to anybody, so there's no need to check a credit score. There is debt that's taken out at the property level, but that is debt that is in the name of the LLC. It's not in the name of the investors. And so that's why in the prepared remarks, Cam was talking about how it doesn't matter what your credit score is, because we don't ask for it. And the debt is, we're a corporate borrower. The LLC is a corporate borrower, so it doesn't depend on the credit score of its owners. Next part was on taxes. So we distribute a 1099 DIV form each year. You'll basically get one tax form, no matter how many different properties you invest in, that consolidates all of the income and all of the items onto an easy form. And then you can just give it to your tax accountant or upload it to TurboTax. Super simple. And what's really nice about that tax setup with the 1099 DIV is that it doesn't create a tax liability in any other state. So you could invest in properties in 15 different states, but you wouldn't need to file a tax return for 15 different states. You would just file at the federal level and for wherever you live. It's really nice because it doesn't create a bunch of extra paperwork and headache for no reason. And the third piece is on bank accounts. So we link to your bank account so that we can fund the properties. That's how we take investments right now. We don't have an option yet for credit card or crypto or anything else like that. And the good thing is that once we have your bank account connected, we have a place to send your dividends. So every 3 months when we distribute that rental income, we just do a direct deposit to your bank account, and then you can use that money to go and invest in other properties or go buy a coffee or do whatever else you want with it.
Yeah, awesome, Jake. Paulina, I saw you had a question about a property that you've invested in, potentially the Lily, and it looks like there might be some technical errors with hearing. If for whatever reason, I'll follow up post-webinar. Happy to connect with you. We can either chat via email or hop on the phone. I will say too, a quick plug that we will get to as many questions as we can. This is being recorded, so you'll receive an auto replay. And if any questions aren't answered, you can either set up one-to-one time, or I'm happy to answer via email as well. Walking right through here, Chris, I know you asked about factors determining when to sell a property. Cameron, any further way we can expand on that? I think it's another one came up in terms of selling. Are there any other factors that we're looking for after that 5 to 7 years, or prior or after?
Was the nature of the question, what are our cues to sell?
Yeah, yes, exactly. What are the cues to sell?
Yep. Yeah, I think that it's tough to know because we're still a few years out, but it'll largely be dependent on the state of the market. So if we've been chugging along and the market has been steadily appreciating 4 or 5% a year, then we would feel good about selling, because at that time, the thesis has played out and there's nothing materially affecting that sell thesis. Hopefully, 5 years from now, the cost of selling a property is much cheaper than it is today. Right now, it's around 6 to 8% when you factor in real estate commissions plus all sorts of other settlement transaction fees. So paying a title and escrow company, paying for the third-party closing, et cetera. There are all sorts of fixed fees like that go into that 6 to 8% number. And really the only other guidance that I can give is what I alluded to earlier, was if we're not at a sufficient gain yet, net of transaction costs, we're just going to keep going, keep paying out the dividends. And then, hopefully that you'd be able to stay on the ride the whole time for that levered appreciation exit, but we will have liquidity available, hopefully coming very soon, for you to be able to trade out of it in the event that you would like to capture whatever sort of gains, or if you need the cash.
Awesome. Thank you, Cameron, for sharing more light there. We have Team Pat and Donna on the line talking property management. So Cameron, those taxes, trash, and toilets, who manages the properties to date?
We utilize a network of national tech-enabled third-party property managers, and we are on the institutional side of their business as opposed to the retail side. So what that means for our investors is that there is typically 2 branches within a property management company. It's those that serve larger investors, and then those that serve individual retail clients. So as you may have already guessed, the retail clients are often paying more for each service, as well as not getting too much personalized service. So when we work on the institutional side of the business, we have a client-facing team that pretty much takes all of our requirements and then creates a network and a profile for our management specifically. So we can specify a lot of things such as underwriting requirements. We can specify the 2-year leasing requirements. We specify our rents, and we basically make the process optimized with them, where a retail client would have a hard time getting a property manager to cater to their exact specifications. So between better pricing and more dedicated operations, that is some of the advantage of working through Arrived as a conduit, because we don't make money on property management. It's a pass-through service for us. Like you just pass on the cost, but we get better access to better pricing and better services.
Yeah, and I think too, having boots on the ground in each location mitigates any risk that could come up with those tenants as well. So as little as, well, not little, because it's a big thing, the refrigerator going out, a heater, so on and so forth, they'd be able to tackle essentially quickly to take care of that as soon as possible. So they have those operational efficiencies that we lean on that help support obviously our tenants, but then making that rental income for you as an investor.
Yeah, and the other part that I failed to mention in that is that you kind of get 2 property managers in one with Arrived, because we also have an asset management function where we are effectively driving the whip on the property managers, as well as making the more capital efficient allocations of cash. An example of that would be like the fence that I talked about on the prepared remarks, where for a small investment to make sure that the home has a fence, it pays off really good returns over the whole investment period, in the sense of better rent, lower vacancy, and that fence is still there whenever we're going to sell the property. So the future buyer of that property is also going to be paying for that fence, in a sense, and you get your money back on that. So a property manager does not typically make those types of decisions or recommendations, but Arrived's asset management team makes those value add decisions, as well as keeps the property manager honest, kind of as a full-time job.
Yeah, totally makes sense. And I realized too, Michelle, like I went right past your question. Right now, we do require a bank account to be connected. However, we are looking to expand this in the future. But as it stands today, you can connect via Plaid, or you can upload a voided check or bank statement with your name to your account. If you need to reach us, it's either support@arrivedhomes.com. We also have a chat widget in the bottom right-hand corner of our platform, where you'll likely see myself or Jake on the other side. Awesome. Moving through here, Lucinda had a question. I want to make sure I answer this in the right way. It's a sellout just having your share rate meet or actually selling the property. Cameron, I'm going to kick this one to you. Let me know if you need clarification here.
Yeah, so when we're referring to the 5 to 7 year hold period, we would be talking about selling the property in the physical world to a different buyer. But there's also another variation of it when I refer to liquidity and redemption. So Arrived is creating a program right now to be able to buy your shares back at a market determined price using third-party valuation and estimates of that property. So if you needed to tap into liquidity or trade your stock and your shares for cash, Arrived would be able to facilitate in the near future. But in the long run, 5 to 7 years, the ultimate cash out for all investors is selling it in the physical world.
Wonderful. Clarice had a question around our next drop. Jake, I'm going to kick this one over to you. When will we announce new markets in April? Do we have anything coming up in Dallas, Fort Worth, or surrounding cities?
Yeah, we've got our next batch of properties is going to be coming up in early April, about the first week in April. Definitely stay tuned to your emails, because we'll send out a notification when we have the date confirmed, and then another email when the properties are released. It's a great batch of properties. We've got, I think, 1 in Nashville, 1 in Columbia, South Carolina, and 4 in Birmingham, which has been an awesome market to get into. And I'll let Cameron talk a little bit more about what we like in Birmingham, as well as our future Texas expansion plans.
Yeah, Alabama is a great market in general. It's not typically what would come to mind first, in terms of name brand recognition, but that's actually where the opportunity is when you don't hear about a lot of places. It's got the second lowest property taxes in the country too, next to, I think, Hawaii of all places. So strong cash flows there, good assets at good entry prices, and with remote work culture and capabilities, I'm anticipating that on the long run, because they are attractive price points right now. You'll have more and more people flood into those markets because of the cost of living. So we're pretty hopeful there. And as far as Texas goes, I think, I've definitely had my eye on it, and I'm actually from Houston. So, I do know a fair amount about Texas. One of the challenges, I'll tell you, is the high property tax rates over there. And there's a lot of large institutional investors. So we're just looking for the right entry point, the right asset class, and the right timing of everything to go into Texas. But certainly Dallas-Fort Worth is one of the best markets in the country in terms of just growth. I think it went from the number 7 to the number 4th highest MSA population in a decade. And Texas in general has got, I think, 3 of the top 12 largest MSAs in the country between Houston, Dallas-Fort Worth, and San Antonio. And I'm sure many people have heard about Austin, Texas, as a great place to invest. So we're just figuring out the right product mix to be able to get into each of those markets, but it's definitely on our radar. Don't have an exact timeline yet, but just trying to figure all of those details out.
Yeah, hot to say the least. Cameron, we walked through obviously acquiring homes, acquiring great tenants. On the flip side, can we also walk through vacancy? So how long it typically can take to have a tenant? I know you mentioned seasonality as well, but can you walk through that average time and what happens in that process where you're getting a home ready?
Yep. In the spring and summertime, a lot of the properties that we put onto the market now will lease anywhere from about 14 to 45 days. And then during the fall and winter time, they will lease in about 30 to 90. And the reason is that in the single family residential asset class, it follows a lot of the patterns of seasonality with respect to changing jobs and starting school. So when you're looking for a house, there's not too many people looking for a rental house in November. So demand can dry up a little. We're looking to mitigate some of that for our investors. We're abstracting away some of that volatility and seasonality by trying to pre-rent some homes before we release them out. So that way, when we're offering them on the platform, they would already be cash flowing to kind of take on the burden of some of that vacancy before selling it to the investors. Those are some of the things that we're looking at doing. And then when we acquire a property, it'll take anywhere from 2 to 4 weeks to get it into a rent-ready state, depending on a confluence of factors such as the year built, the availability of vendors, things like that. So some properties require more extensive rehab, such as putting in new flooring, building a fence, redoing the house. And in those cases, we're looking more like a 4-week time period before we're even ready to market the property. Others are in pretty turnkey conditions. So we're doing we always clean our properties every single time before we rent them. And we do some basic X's and O's just to make sure that it's got the right curb appeal. So when we do put it on the market, it's got the highest chance of leasing outright. But those are some of the things that, or at least timelines to be aware of when investing. But over the long run, I hope we get to the point where we're working towards the point where we are getting rid of that seasonal component, whether it be through different assets or different programs where we're absorbing the vacancy for you, and then offering you a very consistent investment experience, regardless of whether you were investing in May or November.
Wonderful. I know we had a few questions around our loans. Jake, I think you covered those when you walked through that question. Typically, we close out at the top of the hour. So I'm going to funnel 2 questions and then we'll close things out. I know there's a lot in here. So we have multiple ways to get a hold of us via email, call, carrier pigeon. So I'll make sure that all of that is consolidated in our follow-up email. Moving forward here, Isabel had a question. Jake, I'm going to kick this over to you. Can my company invest as opposed to me personally?
Sorry, they're looking for the mute button. Yeah, so you can create an individual account where you just own the shares in your name. You can make investments for yourself, or if you have a company, you're more than welcome to invest. When you go through and select for an entity, there's options for an LLC, an LP, corporation. So if you already have an entity, you're more than welcome to use it to invest with. There's not a huge advantage to or to not, because investors already don't have any liability and are kind of silent investors. There's not a reason to spin up an entity just to invest with Arrived. But if you already have one that you use for investing purposes, or if you have a business and you'd like to make the investment in that business's name, then you're more than welcome to.
Wonderful. Cameron, I'm going to kick this one to you. As investors, can we take the depreciation off our other passive income gains?
So, no, the depreciation is specific to the entity that is claiming it. So it would be limited to the LLC. So we're not, what that implies then is that we're not super aggressive with our depreciation schedule, unlike some other assets or companies that may want to implement those aggressive depreciation policies. So as a REIT, we're not able to carry forward any material amount of loss. So there's no advantage for us to accelerating that depreciation, but because it's within the context of one LLC as opposed to a bunch of different assets under your specific entity or name. If that was the case, then you could, but because it's a segregated LLC from the rest of your assets, you're not able to capture that depreciation and allocate it to other investments.
Yeah, thanks for walking through that, Cameron. I know there's a myriad of questions. We do have to wrap things up on our side. That said, we will have another webinar next Tuesday at 9 a.m. PST, and then we have another one following that on Friday at 1 p.m. PST. So this time, for everybody on the line, this will be recorded, so you will receive a replay shortly. That said, I saw Jake plugged our phone number, our email, support@ArrivedHomes. We're available on social, so Facebook, Twitter, Instagram, Reddit. We have a sub page. Feel free to chat there. Am I missing anything, team, on communication wise? Wonderful. We'll have homes dropping here shortly, so stay tuned. We usually share that information from the rooftops and also via email and social as well. So thank you all for joining today. Cameron and Jake also for your time as well, and we will catch you all next time.
Thanks, everyone. Great questions.
Thanks, everybody. A lot of great questions. If we didn't get to you, just email us and we'll make sure we get you some more information.
All right. Thank you.
Bye.